Hey everyone, welcome back to Corporate Decoder. Today we're looking at Cycurion 1, and let me tell you, they've been busy making some serious financial moves, and it's going to sound a bit like a corporate swap meet in here. Alright, so what we have here is a company called Cycurion, and they're filing what's called a Form 8K. Think of this as a way for them to quickly tell the public about major events that happen between their bigger regular reports. The big news today is that on August 12, 2025, Cycurion has been very busy making deals to sort out its finances. They're basically trading away some of their old debts for new types of stock. This is like paying off a credit card with a different kind of loan, but in the stock market world. They've done this with several different companies or investors. First up, a place called Alpha Capital Anstalt. They're exchanging $366,050 worth of debt for 366 shares of something called Series G convertible preferred stock. Then there's M2B Funding Corp. They're doing a similar thing but with a bigger amount. They're swapping $672,077 in debt for 672 shares of that same Series G preferred stock. Next, ADI Funding is exchanging $347,730 in debt for 3048 shares of Series G's preferred stock. We also have Deltinium. They're exchanging $617,677 in debt for 618 shares of Series G preferred stock. Then OSHA Capital is exchanging $103,800 in debt for 104 shares of Series preferred stock. Lexi London is on board too, trading $769,000 in debt for 769 shares of this preferred stock. And finally, Ale Associates is swapping $256,333 in debt for 256 shares of Series G convertible preferred stock. So they've basically converted a whole bunch of existing debt into this Series G convertible preferred stock. Now, what is this Series G preferred stock? Well, it comes with some specific rules and benefits for the people holding it. These shareholders get to vote on company matters, but their votes are counted as if they had already converted their preferred stock into regular common stock. It's a bit like having a vote, but with a condition attached. They also get a dividend, which is like a share of the company's profits. It's set at 12% per year, but here's the twist. These dividends are paid out in more common stock, not cash. So the company is essentially giving away more of its ownership over time to these preferred shareholders. As for converting, holders can swap their preferred shares for common stock. The rate is pretty significant. 1 share of this Series G preferred stock can become 1,000 shares of common stock. But there are limits called blocker limitations of either 49 too much control too quickly. If the company were to ever shut down or go through a major financial shakeup, these preferred shareholders get paid back first, before any of the regular common shareholders get anything. They get their initial investment back plus any unpaid dividends. And importantly, they have some serious say in major company decisions. The company can't change the terms of this preferred stock, amend its own founding documents in a way that hurts these shareholders, or increase the number of these preferred shares without getting a majority vote from the preferred shareholders themselves. This gives them a strong hand in steering the company's future, especially when it comes to protecting their investment. Now, the company is adding a bit more context here. They're calling this a strategic recapitalization to strengthen its balance sheet and support growth initiatives. Essentially, by turning debt into this preferred stock, they're reducing their immediate debt obligations and getting a cleaner financial picture. They are saying they've converted about $3.2 million of debt into 3,133 shares of this Series G preferred stock. This is a significant move to bring down their debt load and bring in what they consider more stable equity. On top of this debt swap, they're also planning to keep using something called an equity line of credit, or ELOC. This is a prearranged deal where a company can sell its stock to an investor over time up to a certain amount. They have $55 million left on this line of credit and plan to use it to get more money for operations and future plans. However, to sell more stock under this credit line than they've already agreed to, they need to file new paperwork with the SEC. This is just a regulatory step to keep everything above board when accessing those funds. Now, here's a really important detail. To stay listed on the Nasdaq stock market, which is a major exchange, companies often have to keep their stock price above a certain minimum. When a stock price gets too low, companies might do a reverse stock split. This means they'll combine a number of existing shares into fewer shares, which artificially raises the price per share. Cycurion says they plan to do this, but they need shareholder approval first. This is often a sign that the company's stock price has been struggling. They also mention they're always looking for business deals that could make them more profitable or increase the value for their shareholders. It sounds like they're actively looking for ways to improve their financial standing and grow. And finally, they list out all the new agreements they've made as exhibits. These are the official documents detailing each of these debt for stock exchanges. We see the Alpha Capital Anstalt Exchange Agreement dated August 12, 2025. The M2B Funding Corp Exchange Agreement also dated August 12, 2025. The ADI Funding Exchange Agreement, again from August 12, 2025. The Deltanium Exchange Agreement, also August 12, 2025. OSHA Capital's Exchange Agreement, dated August 12, 2025. Lexi London's Exchange Agreement, dated August 12, 2025. And the ILE Associates Exchange Agreement, dated August 12, 2025. These are all signed off by L. Kevin Kelly, the Chief Executive Officer. The report itself is dated August 25, 2025, but the events being reported happened earlier in August. So what's the big picture here for Cycurion? They went through a significant financial restructuring, swapping a good chunk of their debt for a new class of preferred stock. This is often a move made by companies that might be struggling a bit, trying to get their financial house in order. By converting debt to equity, they reduce interest payments and can show a healthier balance sheet. However, giving away a lot of preferred stock, especially stock that can be converted into common stock later, can be dilutive to existing shareholders. This means their ownership stake could become smaller as more of this preferred stock gets converted into common stock later, can be dilutive to existing shareholders. This means their ownership stake could become smaller as more of this preferred stock gets converted into common stock later, can be dilutive to existing shareholders. This means their ownership stake could become smaller as more of this preferred stock gets converted into common stock later, can be dilutive to existing shareholders. This means their ownership stake could become smaller as more of this preferred stock gets converted into common stock. The fact that they're planning a reverse stock split to stay on Nasdaq is a big flashing signal. It tells us their stock price has likely fallen quite a bit and they're trying to artificially boost it to meet listing requirements. This isn't always a positive sign for the company's underlying performance. While they talk about growth initiatives and using their ELOC to raise capital, the need for these types of maneuver like debt to equity swaps and reverse stock splits often suggests they need cash to keep the lights on and maybe fund operations rather than aggressive expansion. The overall direction here seems to be a company trying to stabilize itself. They're reducing immediate financial pressure by converting debt and are looking to raise more capital. The risks for investors are definitely dilution from the preferred stock conversion and the potential for continued stock price struggles as hinted at by the reverse stock split. The opportunity is that if they can successfully execute their growth plans and manage their finances effectively from this new footing, they might turn things around, but based on these filings, it's a company in repositioning mode, and that often comes with significant challenges and risks for existing shareholders. Alright, that's our breakdown of Cycurion's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.